Picture this. It is a Tuesday in late September. You open your credit card app to check your balance before making a payment. The minimum payment due is $47. Last month, it was $35. You think there must be a mistake. You look at the balance. It is roughly the same as last month, maybe slightly higher. But the minimum payment jumped by $12, and you cannot immediately explain why. Here is why. 1 week earlier, the Federal Reserve raised its benchmark interest rate by 0.25 percentage point. Your credit card has a variable APR. Variable APRs are tied to the prime rate. The prime rate moves in lockstep with the federal funds rate. The moment the Fed raised rates, every variable rate credit card in America automatically became more expensive. The minimum payment did not go up because you spent more. It went up because a room full of people in Washington made a decision, and your credit card company adjusted your rate before you even knew the meeting happened. The $12 is not the story. The $12 is the signal. The story is that the same mechanism that raised your minimum payment simultaneously raised the cost of every variable rate debt product in the American economy in the same week. By the end of this video, you will understand exactly what the Federal Reserve is about to do, why they are doing it, what it cost you specifically in your household, and 4 actions you can take in the next 26 days before the decision is made. If that sounds like information your bank statement will not volunteer, hit subscribe. Let's get into it. Here is what is actually happening right now. And I want to be precise about the timeline because this is not a general video about interest rates. This is a video about a specific decision that is scheduled to happen in 26 days. The Federal Open Market Committee, the group inside the Federal Reserve that sets interest rates, meets on September 15th and 16th of this year. That is the next scheduled meeting. The benchmark federal funds rate currently sits between 3.5% and 3.75%. That is where it has been since December 2025 when the Fed made its last move, a rate cut, the third consecutive cut of 2025. At the beginning of 2026, most Americans and most Wall Street investors expected more rate cuts to follow. The forecast entering the year was broadly that borrowing costs would continue to fall. If you made financial decisions this year based on that expectation, waited to buy a house, kept a credit card balance expecting cheaper debt, held off refinancing, you made a reasonable decision based on the signals that were being sent at the time. The signals have changed. At the July 29th FOMC meeting, the committee voted 9-3 to hold rates steady. The 9 votes to hold were not the story. The 3 dissents were 3 Federal Reserve regional bank presidents, Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas, voted to raise rates immediately at the July meeting. They did not want to wait. They thought the current rate was already too low given inflation. They were outvoted 9-3, but their dissents are on the record, and they are not backing down. This week, Cleveland Fed President Beth Hammack renewed her call for immediate interest rate increases to address inflation. Bank of America Global Research said in an August 7th note that a September rate hike is still firmly in play. The CME FedWatch Tool, which measures market probability of Fed decisions based on futures trading, currently projects a 55% chance of a 25 basis point rate hike at the September meeting. That is not a certain hike. It is a likely one. And the difference between September and right now is 26 days. Why is the Fed considering raising rates when most Americans are still struggling with the cost of living? The answer is the mandate. The Federal Reserve has 2 jobs: maximum employment and stable prices. Stable prices means inflation at 2%. Core inflation, in the measure that strips out volatile food and energy prices, is currently running at 2.5%. That is above the 2% target. It has been above the 2% target continuously since March 2021. That is more than 5 years of inflation running above where the Fed wants it. The Fed's only tool for reducing inflation is raising interest rates. Higher rates make borrowing more expensive. More expensive borrowing reduces consumer spending. Less consumer spending reduces demand. Less demand puts downward pressure on prices. The mechanism works, but it works slowly, and it works by making credit more expensive for ordinary Americans while it does. Adding to the pressure, energy prices have been rising due to tensions in the Middle East. Energy price increases ripple through the entire economy because energy is an input to almost every product and service. Transportation, manufacturing, heating, agriculture. When energy prices go up, inflation tends to follow, even if the Fed raises rates. 3 of the Fed's own regional presidents look at that combination. Core inflation at 2.5% plus rising energy prices, and conclude the benchmark rate of 3.5% to 3.75% is not high enough to get the job done. That is why a rate hike is on the table. It is not punishment. It is arithmetic. When the price level is too high by their measure, the only tool they have is to raise the cost of money until the price level comes down. Here's what a 25 basis point rate hike actually does to your household bills. And I want to be specific because the mechanism is different depending on what kind of debt you carry. Credit cards. This is the most immediate and the most widely felt impact. Credit cards have variable APRs. Variable means they adjust automatically when the prime rate changes. The prime rate is always exactly 3 percentage points above the federal funds rate. When the Fed raises rates by 25 basis points, the prime rate goes up 25 basis points, and your credit card APR goes up 25 basis points on your next billing cycle. You do not get a notice. You do not get a choice. It adjusts automatically. Americans currently carry $1.25 trillion in credit card debt. That is a record. The average credit card balance per household carrying a balance is approximately $6,500. A 25 basis point APR increase on a $6,500 balance adds roughly $16 per year in additional interest. That sounds small, but that is one hike on one balance. The prime rate has moved significantly over the past 4 years, and every hike stacked on top of the last. A credit card that charged 15% APR in 2021 may be charging 26% or 27% today. Every quarter-point hike adds another layer to a cost that is already dramatically higher than it was for the same person carrying the same balance 3 years ago. Home equity lines of credit, HELOCs, are directly variable rate. They adjust almost immediately when the Fed moves. If you have a HELOC with a $50,000 outstanding balance, a 25 basis point rate increase costs you roughly $125 more per year in interest. Most HELOC holders do not monitor this closely enough to notice the quarterly creep. But over a year of holding a HELOC balance through a rate-rising environment, the cost adds up to real money against real household cash flow. Auto loans. If you have an existing fixed-rate auto loan, the hike does not affect your current payment. But if you are financing a new vehicle in the next 60 to 90 days, the rate environment you borrow in will be more expensive after the September hike than it is today. On a $35,000 vehicle financed for 60 months, a 25 basis point rate increase adds roughly $220 in total interest over the life of the loan. Not catastrophic, but not nothing when most buyers are already stretched at current rates. Mortgages are the most complex piece of this. The 30-year fixed-rate mortgage does not directly track the federal funds rate. It tracks the 10-year Treasury yield. However, the expectation of a Fed rate hike pushes Treasury yields higher because investors price in the future rate environment. This means mortgage rates can rise ahead of the actual hike as the market prices in the probability. The average 30-year fixed rate today is 6.63%, the highest point of 2026. Some analysts believe rates are already partially reflecting the September hike probability. If the hike happens, mortgage rates could push further toward 6.75% or higher by end of year. For anyone looking to buy a home in the next several months, the rate environment matters enormously. The difference between 6.5% and 6.75% on a $300,000 mortgage is approximately $50 per month and roughly $18,000 in total interest over 30 years. Not because you borrowed more, because the rate went up a quarter point. Now, let me give you the number that puts this in context. Americans currently hold approximately $18.8 trillion in total household debt. That includes mortgages, auto loans, student loans, credit cards, and HELOCs. Not all of that is variable rate. Fixed rate debt is insulated from rate hikes. A 3% mortgage from 2021 stays at 3% regardless of what the Fed does at the September meeting. The hike does not touch it. Variable rate debt is different. Credit cards are almost universally variable rate. HELOCs are variable. Some auto loans are variable. Some private student loans are variable. Adjustable rate mortgages are variable. The total outstanding variable rate debt exposure in the American economy is in the trillions. A 25 basis point increase across all of it represents billions of dollars in additional annual interest payments flowing from American households to American lenders in the 12 months following the hike. This is the mechanism the $12 minimum payment increase was telling you about. It was not $12. It was $12 on one account for one person in 1 month of a system where the same mechanism runs across every variable rate account simultaneously. Here is the most useful distinction in this entire video. Know which type of debt you have. Fixed rate debt is protected from rate hikes. If you locked in a fixed mortgage, a fixed auto loan, or a fixed personal loan before or during this rate cycle, your payments on those loans do not change. The hike is irrelevant to those specific accounts. This is the financial benefit that people who locked in low fixed rates during 2020 and 2021 built into their balance sheets. A protection that becomes more valuable every time the Fed raises rates. Variable rate debt adjusts automatically. If you carry a credit card balance, have a HELOC, or hold any variable rate debt product, a Fed rate hike directly increases your cost. It adjusts whether you notice or not. It adjusts whether you agree with the Fed's decision or not. The only way to stop the adjustment from affecting your specific account is to pay off the variable rate balance before the hike takes effect or convert it to a fixed rate product. Knowing which category each of your debts falls into is the single most practical thing you can do with this information before September 16th. Here is what you actually do in the next 26 days. First, list every debt you carry and identify whether it is fixed or variable. Credit cards are variable. Your HELOC is variable. Your 30-year fixed mortgage is fixed. Your fixed-rate auto loan is fixed. Go account by account. Fixed-rate accounts require no action. Variable-rate accounts are where the hike hits. Second, aggressively pay down variable rate balances before September 16th. Every dollar of variable rate balance you eliminate before the hike is a dollar that never gets repriced at the higher rate. If you have $3,000 across 2 credit cards and $2,000 in savings, you can safely deploy. Paying down $2,000 before the meeting saves you money at a guaranteed return equal to your current APR, which is almost certainly higher than any savings account is offering. Third, if you have a HELOC or adjustable rate mortgage, contact your lender and ask what options exist for converting to a fixed rate. Not all lenders offer this, and the conversion may or may not make mathematical sense depending on your specific situation. But the conversation costs nothing, and the information is worth having before the September meeting rather than after. Fourth, if you are planning to buy a home or finance a vehicle in the next 60 to 90 days, do not wait for rates to fall. The CME FedWatch is currently pricing a more likely hike than hold at the September meeting, and no major analyst is predicting a rate cut before year-end. Waiting for lower rates in the near term is no longer the rational expectation it appeared to be at the beginning of the year. Go back to that Tuesday in September. The credit card app. The minimum payment that jumped from $35 to $47. The $12 that arrived without a notification, without an explanation, without anyone volunteering what caused it. Now you know what caused it. And more importantly, you know it has not happened yet. The meeting is September 15th and 16th. Today is August 20th. There are 26 days between right now and the decision that adjusts your minimum payment upward without asking for your input. The Federal Reserve raising rates is not something that happens to the economy in the abstract. It is something that happens to your credit card statement, your HELOC payment, your next auto loan rate, and the mortgage rate you will be quoted on your next home purchase. You have 26 days. The decision will be made regardless of whether you understand it. Understanding it gives you 26 days to do something about it before the mechanism runs automatically and the adjustment appears on your statement in September. The rest is the list, fixed or variable, and what you do about the variable ones before the 16th.